Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Shad and Corey here, your host for this weekend show. First half of the show, we're going to be focusing on the metals sector, investing in a wide range of metals, including looking at what the large companies are doing and filtering down to development stage projects, and probably also touching on exploration projects, what you should be focusing on. Back end of the show, we're switching our focus to the energy sector, more oil and natural gas, as those markets have been quite strong and those stocks have been responding to the nice bump in prices that we've seen over the last month, at least for the oil price. We are kicking off the show with Joe Mazumdar, editor of Exploration Insights. To visit Joe's website, click on our website or visit our podcast. Just search the KE Report. Listen to the weekend show and find that link in the show notes. Joe, let's start off at the top of the food chain with the majors. The majors, it seems like, continue to build up cash positions. They are investing a little bit down the food chain, but as much as I hear about how the resource investors are waiting for generalists to enter the space, I keep on looking at the majors. They need to lead that charge and draw in some of these other investors because, well, they're at the top of the food chain. That's where investors come into the sector first. They don't bother going down into smaller companies. They look at the market leaders. Joe, in your eyes, what are the majors doing that can help out the overall sector and actually draw in some other investors?
Thanks, Corey. Well, I would say, depending which sector we're talking about, commodity gold, let's say, versus copper, gold and silver versus copper. If we look at gold, one of the overhangs for M&A of projects was the Newmont divestments that they did, which they managed to get about several billion out of. As they were merging with Newcrest, they were reprioritizing assets and they divested a lot. So there was a bunch of companies who were interested in acquiring or M&A transactions that weren't buying juniors or single asset developers, but they were looking more at a producing asset that would come out of Newmont. That's gone. So now the next layer of growth potentially for these guys, especially the intermediates, would be like those single asset developers that are still, in terms of valuation, relatively cheap, some very cheap. And then one part of that is because retail that like gold, they don't like development stories, they like exploration stories. And so once they get into that, let's say the valley of death, in terms of development, the retail has left. And so there's not much liquidity. Their shares don't move. And so it's a great opportunity for a producer that can show growth to acquire. Problematically is some of these that have been acquired, the cheap buying the company, but not cheap building the asset. And you can ask B2 Gold about, Sabina and building the Goose project. So, I think companies will be looking at not only permitting, how long will it take to permit, but also checking those capital numbers to say that they're happy about that. Water access will be important. So all those things is what a single asset developer will have to get checked with respect to attracting suitors in terms of the development stage. In terms of exploration, I see more on the copper side where I see majors going upstream and leveraging off junior companies' expertise in a jurisdiction or a style of deposit that they don't have potentially, because a lot of the experience in that has gone to the juniors as the older, more experienced people in big companies retire and then they start doing something else and they end up in a junior company. So it's not like the major always has more of the intellectual property. Sometimes the junior does. And jurisdictionally they could as well, because they could be in a place for a long time. So I see companies like Teck doing a lot of these private placements. We saw this, and they could be private placements or or also project earn-ins. So dilution either in the numerator on the project or the denominator with respect to equity, and sometimes both. But given their cost of capital to go to the equity markets to raise the kind of capital that they would need to do a decent exploration program, it's cheaper to get the money from industry. And I see that trend continuing into 2025.
Well, Joe, let's dive into that even a little bit further. You brought up a great point off mic before we started recording today about kind of the differences that you see when the larger companies really do an earn-in at the project level versus just coming in at the equity level and the different ways you view that.
Yeah, I mean the problem with like most retail, probably more so in the buoyant markets, would not want to see project dilution. They want a company to own 100% of that asset as long as they can until they can get taken out, let's say. But problematically, especially with the copper projects that require a lot of money to drill, juniors can't maintain that spend, and it's constantly dilutive. And so it's better to get that commitment from a major to earn into the project. So if you don't hit that great hole that drives your share price and doubles it so you can go back to the markets and raise money, but it's an encouraging hole, the major that's earning into the project will still be encouraged and continue to earn in, whereas the retail market will not. Because they're just looking at the grade numbers. They're not checking the alteration. They're not checking the vein density. They're not checking all these other things that would still make a geologist or the exploration team of a major still excited about a project. And so those sort of earn-ins, even though you might dilute to 30%, that's a lot more reasonable than diluting your share structure by 5 times or plus over an extended period of time to explore this well. And I think the bell of the ball, the Aurora discovery with AMARC, with those results coming out in early January before the BRIC conference, the MIF, the Metals Investment Forum, and also AME, showed that even if you're diluting at the project level and not the equity level, you could still generate a big return. I mean, that share price went up 2 or 3 times based on those intersections that they got out of the Aurora project, which was a prospect that they have in a joint venture earn-in with Freeport.
So if you like these earn-ins better than equity investments, are there any red flags when you see some of these earn-in agreements that do worry you a little bit? Because there can be a lot of moving parts when it comes to some of these earn-ins.
Yeah, my problem on the earn-ins is about the flow of news. Some companies get real, let's say anally retentive about news flow and then control how the news is put out such that the junior does not have a lot of leeway in terms of distributing the news. And sometimes it'll only come out at the end of a quarter, even though, the news happened like maybe a couple of months ago, because the big company will say, oh, that's not material to us, so I'm not going to put it out. And then, but to the junior, that it is very material. And so you definitely need a strong management team that will insist, and a strong project that would insist that, okay, if I have news, it's material to me, we're putting out. You get to look at the news release, but you can't stop it. And that's very important. So if you're invested in the junior, news flow and catalysts are very important. But if there's any restriction on the news flow by the major, that's obviously a red flag.
Well, Joe, just thinking about how some of this eventually translates over to M&A deals and takeovers, which is what a lot of investors want to see. Is it possible that people are spending so much time obsessing on what Newmont or Barrick are going to buy that they're missing the fact that most of the takeovers we've seen in the last couple of years have actually been the mid-tiers taking over development projects or single asset producers? I mean, yeah, we did see Agnico take over O3 recently, and we did see Goldfields take over Osisko Mining, but you brought up B2 Gold and Sabina. I was thinking of Aura taking over Bluestone, or Orla taking over Gold Standard Ventures, First Majestic taking over Gatos, Silvercorp taking over Aventus. I mean, there's a lot of mid-tiers doing a lot of action. Should people maybe hone in on what some of the mid-tiers want?
I am more almost focused on the mid-tiers because the acquisition of a single asset developer would have more of an impact on their growth than a major. So majors are right now are seemingly more interesting in merging with another major, whereas the intermediates can still show incremental growth by acquiring a single asset developer and taking a leg up. And given the valuations, if it's the right project, correct infrastructure, jurisdiction, it could still be very to the intermediate. And now, given where we're sitting with respect to the cost of capital for a single asset developer, if you get an intermediate with a portfolio of assets and cash flowing and a decent balance sheet, their cost of capital will be much lower. So, who can build the project? That's really not a choice. You definitely go for the company that's intermediate. And so you, as a shareholder in the junior, would be willing to take shares of the intermediate because it's an exit for you, but also you could maintain leverage to the asset if you think it's, a really good asset. And then also you would still see growth in the intermediate. Whereas in a bigger company, you might not even see the impact of that asset in that company's portfolio.
Yeah, that's so true. But that's also because these large companies are just so much bigger than the rest of these other, I guess, developers and also smaller scale producers. Is there any companies in mind that you have of these mid tiers that you see as building out a nice pipeline that I guess could eventually make the jump into being considered a bit more of a major, or even more importantly, to your point, have the ability to fund expensive project builds?
Yeah, I mean, one that stands out probably in terms of, a company that would be looking to acquire, like I would be looking at, growth profile and sometimes jurisdictional risk. What drives a suitor to acquire might be different. You might be thinking growth when they might be thinking diversification. Or they might be thinking about not only diversification of having another cash flowing asset, but also away from where their focus is. So a lot of the geopolitical risk that's escalating, creeping nationalism in parts of West Africa may force the Endeavour Minings and some other companies that are overexposed to that area to acquire outside of that jurisdiction. So you might not even be thinking about them, but suddenly they might be acquiring something outside of their so-called backyard. So, and a company with a decent treasury that's looking for growth, like Kumtor with Centerra Gold, that project was taken away from them. They settled, and they ended up with a big treasury. So in terms of they are set up to look for a new acquisition. So, that's another company that's probably on the precipice of doing some kind of M&A transaction. And they'll probably look for something lower risk jurisdiction than try to go back to someplace in Central Asia like Kyrgyzstan again, or the Kyrgyz Republic. I can't remember which one it was. But yeah, so the majors, there's less super majors, obviously. And again, I think that they're more interested in acquiring other producers and merging and lowering their costs by cutting G&A, whereas the intermediates would exactly be what I would be looking for with respect to acquisition of single asset developers.
Well, and Joe, to the point you just made about diversification, we saw some deals where, Mako was in Nicaragua, but they decided to go into Guyana to be part of that Guyana Shield by buying Gold Source. Or you saw G Mining that already had a mine built in Brazil also switched to Guyana to, diversify. Silvercorp getting out of China, going in with Adventus to Ecuador. So we've seen some of that. But what about the ones where something like Magino that was a problem for Argonaut, but Alamos is a large mid-tier, and they came in because they thought the synergies with their Island Gold Mine, with the mill and not having to build a new mill and the tailings were the go, or Coeur buying Silver Crest to fix their balance sheet. So couldn't there even be some other angles as far as some of these M&A deals?
Oh, absolutely. Absolutely. I mean, even with First Majestic getting Gato, just to increase their silver production and potentially their cash flow as they've been basically saddled by their own devices with the Jerritt Canyon asset in Nevada. So yeah, every company is a bit different in terms of there's no single sort of silver bullet that says, oh, this is why everybody's going to be looking. But all we can do is look for the assets that we think make sense to be taken over. If an asset's got a red flag, the probability that would be taken over from any potential suitor with any sort of driver for the acquisition, where whatever it is, but if it's got a red flag, it won't be acquired by any of them. So the asset definitely has to be, check all the boxes for any kind of style of acquisition, whether it's diversification, whether it's growth, whether it's improving the balance sheet, whatever it is, it's still got to be an asset that makes sense. And then also, depending on the suitor, let's say they're not good at underground mining and they usually do open pit heap leach, then the question is, can they do these other projects? Or the one that only does underground, can they do a big bulk tonnage open pit? Those are the other sort of things that the suitor would have to, get comfortable with in terms of taking a new asset on. So companies that do have a comparative advantage in a size deposit, a scale deposit, they might want to stick to their knitting, while others, when they're making the acquisition, maybe they're not only acquiring the asset, they're acquiring the people that understand how to develop that asset.
What about land consolidations when it comes into M&A in these areas that have what seem to be a lot of good projects, but a lot of juniors there? I'm thinking Golden Triangle, and especially now in the Yukon with the Tombstone Gold Belt. Do you see any land consolidation plays coming, Joe?
Yeah, I mean, there's always potential for, expanding. What I see is, in terms of expanding land packages, what I see more of is where there's companies with assets, with plants, with tailings facilities that are running out of ore. And those that are running out of ore will look to juniors that you might not think are big enough, you might not think make much sense, but they have the ore to keep the plant running such that they don't have to start, reclaiming that asset. And so that's another, trend potentially for acquisitions, because people do not want to shut down these, plants that have been going for such a long time, and also take advantage of the fact that, if they had to permit a new facility, it would take whatever 5 to 10 years in some jurisdictions.
Joe, what do you think about the trend of some of the juniors that are developers deciding to team up and put two development projects into the same company? I'm thinking of things like NextGold, where you combined Signal and Treasury together, or something like Stellar, where they combine Nighthawk and Monarch together. Do you like that idea of two development companies massing up in size?
Well, I mean, the problem with that is that, if retail doesn't like development, they like two development assets even less. But it does allow, you to, it's mostly, for me, the big advantage would be the institutional or high net worth shareholder that owns both companies and does not want to pay 2 times G&A. He would rather consolidate the management, cut the G&A, and have management decide which of the two assets they want to focus in on. That's really the person that does well out of those transactions.
Yes, sure seems to be. We are seeing a consolidation of companies, which I think is good. But again, we need these assets built. But Joe, do you see a major move towards building more mines? And building them profitably is a whole other conversation. But do you think that this year, next year, the next couple of years, let's say, all of a sudden capital frees up and companies are able to build these assets?
Okay, so it depends on the commodity. So for gold, the way gold price has gone, there will probably be more people interested in developing gold projects that make sense. And silver, the way Mexico is going, I think there are people that are, very willing to develop silver-rich assets. Copper, more difficult because the copper price hasn't done what the gold price has done. And so, and then all we've had is escalating capital costs. So the capital intensity of copper has gone up, but the price hasn't matched it. So most copper companies I don't believe the incentive price is there for them to build big projects. But saying that, Arizona Sonora, which I have shares in, we've had for a while, they got a private placement from HUD Bay. And so HUD Bay is also building a project in Arizona called Copper World, which is basically the phase one of the project that got stalled there. But it's all on private land, much like Arizona Sonora's Cactus Park Salyer project. And so those are the projects that you probably could build because they're smaller, mostly open pit, and they produce cathode. They're not going to a smelter. And so depending on the project, yeah, I could see some copper projects being built, but the big projects, the size of a Quebrada Blanca too, I'm hard pressed to think of a company willing to take that chance at this copper price.
Yeah, I don't see any huge copper projects on the radar, but if we think about gold, Joe, when we look back to last year, it actually was a big year for projects getting built. I mean, Cote got built, Greenstone got built, Magino got built, Ascot's Premier mine got built, but there was hair on all those deals where they took longer, they cost more. Do you
Well,
think that has
I don't think Ascot's got built. I don't think that's commercial.
Yeah, it struggled a little bit as far as getting off the ground. I'm just saying, as far as big mines in Canada, we saw a lot built, and even Greenstone got their mine built in Brazil. So, do you think, though, some of those having those challenges of cost overruns and longer time frames has other companies hesitating?
Well, the ones in Canada that you mentioned, they obviously took a while to build, and they actually cost more than they wanted them to cost, and they changed the scope, and they went through some management changes as well. And yeah, so and Argonaut with Magino ended up getting acquired by Alamos, and like you said, that was more for the tailings capacity than for the asset to build that open pit project that they were looking at. So yeah, I would say that the gold projects that are going to get built, and then also if we take the fact that West Africa, some West African countries like Burkina Faso and Mali have gotten all the more risky, and people are worried about contagion into other places, not only for security risks, but also increasing free carry, increasing royalties, such that some of these deposits may not make much sense in terms of getting a quick payback in a risky jurisdiction, let's just say. That might force people to other places where they say, oh, maybe under the current U.S. Administration, permitting in the States will be easier, will be quicker than it was before. So maybe I'll go back there. So that's a lot of the movements that we shall see, because governments are changing. Argentina has looked very well. I was down there 3 times last year. Every province there is different, and the province controls the resources. So the good provinces now with the new federal government have gotten all that much better because now the federal government's not an impediment to development. Chile, in another year or so, the left-wing government there is going to be gone, and people are getting themselves set up for that. Peru, the current president there, she's very unpopular, but they're working through a backlog of permitting. And with what's happening in Mexico, some of the silver guys are going down back to Peru to look for silver projects.
One thing that we keep hearing about with all this permitting and companies saying, oh, we think that we might be able to get our permits faster because we have a critical mineral within our project. Man, oh man, we're hearing a lot about antimony recently. Joe, is this just marketing, or do you see any critical minerals designation actually speeding up the process and even making capital a bit cheaper?
Well, I mean, if we go back, a project like Thacker Pass, I don't think in any normal cycle for any commodity would ever get built, given its capital intensity. But Ford came in with money, and also I believe it was the Department of Energy or Defense, I can't remember which. And so if people are actually willing to lend people money, then it's real. But they can't change the lithium price, in terms of how it makes money. But I don't think under the current U.S. administration, we're going to see that kind of money going to critical minerals. But we possibly will continue to see that kind of money going to, let's say, security minerals, which is more of the focus. And those are the the metals and commodities that are getting export bans in China, like antimony, like some rare earth elements. And those are the ones that, that you are concerned about from a supply chain perspective. So the Perpetuas with their stibnite project, that's, I don't know how much it is now in terms of life of mine revenue, but it's not, I don't think it exceeds 10%. It might be 5 to 10%, but with that export import bank, I mean, they potentially could get all of their upfront capital from them. I doubt if they're going to get it all, but still, I mean, they need apparently 1.2 billion, but the letter of intent with respect to the upfront money they're willing to dole out is almost 1.6, 1.8. So I think that will continue. But the problem is a lot of this debt, or let's say low cost of capital for some of these critical minerals, is not going to change, let's say the lithium price or the cobalt price or whatever. Going forward under the incoming administration, I think most of that low cost of capital debt will go to the security minerals. What's nice for Perpetua and these kind of companies is the gold price is doing very well. So the majority of their revenue is pinned to a commodity that's doing quite well. But what antimony is doing is lowering their cost of capital. And that's what is happening. It's not a figment of anybody's imaginations. That's the reality. But it's a good thing in the sense that they're making their money off of precious, but the way they're getting their money in is with the antimony.
When Joe, we had talked about Perpetua and the Stibnite project and how long it took to actually get from the beginning stages to where it is today. I think it's over a dozen years, maybe upwards of 14 years, just to get to this point where they got their final permits. Do investors need to think about that? Because when you think about copper, it's even worse how long it takes to get a mine built and constructed. Do people need to adjust their timeframes?
Well, yes. I mean, let's be honest about this. It's like exploration cycles and retail investment cycles are very different. They want that hit quickly, whereas as we know that, exploration could be 3 to 5 years, almost a decade. Like if you take A-Mark with their project, that's about how long that took to realize this kind of return. The thing about the S&P Global Market Intelligence did like an average, and it was like 15 to 20 years from discovery to commercial production for a lot of these projects. And I when I was down in Peru, I took a look at one, which was Quellaveco, a big copper gold porphyry in Peru that's being built by Anglo American. It was acquired in the early 90s, and it went into commercial production just a couple of years ago. So that's almost a 30-year timeline for this big footprint porphyry copper gold project. And it's not just permitting, not just social license, not just water issues, but it's, companies changing priorities, commodity prices, the cycle of the commodity prices. So all that, goes into how a project's built. And because we think that it's a little bit like tunnel vision, like, okay, you made the discovery. Okay, now you do your feasibility study or your scoping study, your PFS, your feasibility study, and then you get your permit. Then it's 3 to 5 years for construction. Okay, that's the timeline. Well, it doesn't work like that. I mean, the averages the S&P Market Intelligence are giving you is some of these are probably low in terms of what the reality is. I mean, look, again, I keep bringing back the example for the Resolution project in Arizona. I mean, when I worked as an analyst for Phelps Dodge, we had that project coming in to commercial production in 2010. It's now 2025.
Crazy. Hey, Joe, these things take a while, and it's not changing. These things aren't speeding up at any sort of drastic pace. It takes a while from discovery to build, if even an asset gets there. But Joe, let's take a step back then, and I want to hear your just honest assessment of the overall health of this market, because I was actually surprised at the recent conferences, still the number of companies and people saying just how tough this market is, where look, the metals prices are doing well, and I've noticed a lot of positive stories out there from the top of the food chain even down to the explorers, number of companies doing good work, raising money on the back of that, and share prices moving higher. I realize it's not every stock, but look, in your eyes, What's the overall health of this sector? Is this a bull market? Is this still a very much tough sector for investors? What's your overall assessment of investing in metal stocks?
Well, right now, I think it's still a bit of a stock picker market in terms of the right management teams, the right assets in the right places. There's still I think that's still where we're leaning towards, as opposed to all boats getting lifted right now. That's not the case. Access to capital for a lot of these companies is still difficult. And from what I understand now, for Canadian companies with flow through, some of those expiration tax credits, those things, which have to be renewed every year, will be more problematic this year because the government is not functioning, I believe, until March. So access to capital might still be an issue for some of these companies. But again, as we've seen, before, is those companies that have a history of success, that have done it before, no matter what the asset they have, they'll constantly attract capital. So what little capital there is, they'll go to these people. And so that link with the people, and it's all about, the right projects, yes, the right people, but the right people are lowering your cost of capital. They're filtering the asset, but they're also lowering the cost of capital because people are willing to give money to these people, whether equity mostly. And then hopefully they can do some of these private placements at not a big premium to their market prices, as well as not have to issue these 5-year warrants at a 20% premium. So those are the sort of people you want to watch. I think that hasn't changed in the current market.
Okay. Joe Mazumdar, again, editor of Exploration Insights. Joe, it's always great having you on the show. I really appreciate just your honest outlook on these markets and on a number of the companies that we touched on too. Look, I very much value your newsletter, so I hope all of you listening click on that link in the show notes to visit the Exploration Insights website and consider signing up for Joe's newsletter. Joe, again, thank you very much for your time. I hope you have a great rest of your weekend.
Great. Thanks a lot, guys.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report, and now shifting our attention over to the energy sector. I hope you all enjoyed those first couple of segments. Again, focused very much on the metals. Now it's energy time as we're chatting with Josef Schachter. Josef is the founder and editor of the Schachter Energy Report. Also writes the Ion Energy Report, which is a free report. The Schachter Energy Report is where Josef hosts quarterly webinars with his subscribers and also dives very much into specific companies and reports on those, including analyzing some of the earnings, which we will have coming out in under a month's time. Josef, let's start with a quick comment on the overall energy prices, starting with oil. Last time we chatted was at the tail end of December, and after we chatted, actually the oil price almost went straight up for almost a month, reaching a high of just under $80 a barrel. As we're recording this halfway through the week, oil has corrected back down to about $75 a barrel, but that was a strong 3 to 4 week run. Josef, take us through what happened with that oil price and the strength that just all of a sudden came into the market.
Yeah, it's interesting. President Biden always wanted lower prices, so he sold the oil from the strategic reserve, and he didn't do anything really sanctioning on Iran or Venezuela. He even allowed Venezuela through Chevron to produce oil. Chevron provided the diluent, and then they were moving 200,000 barrels a day into the States for the Gulf Coast refineries. And then as this term ended, he said, okay, now let's make things difficult, raise the price of oil for my successor. So he put in the tanker fleet, the Black Fleet, as Russia, has for shipping to load in Russia and then, go change their transponders once they're at sea and then move the oil to India or China, and about 2.5 million barrels a day goes to India, 1.6 million to India, sorry, to China, the bigger number, and then 1.6 million to India. And so you had a push up in the price of crude from under $70 to, as you said, just under $80. And we've given back $4 of that now that it's clear that Russia's already finding ways around the sanctions, as they always seem to do. And we're also now, wondering what the tariffs are going to do. Germany announced recently disappointing economic data. They're in a recession, modest, but a recession. And we're seeing from the U.S. data, inventory builds, as we saw with the data last week. The rest of the data will come out tomorrow, Thursday morning, because of the holiday on Monday, Martin Luther King statutory holiday. So the EIA will report both the natural gas and oil data tomorrow, and I'll have that in my report next week in Ion Energy. So anybody who wants to get a macro update on what's going on with OPEC, U.S. data, geopolitical stuff, and then just general comments that I have on the oil markets and the market impact of it, the Ion Energy is a great free product. So people just go to our website, www.schachterenergyreport.ca, and under subscriptions, they can find the Ion Energy, which is the free macro report.
Well, I recommend our listeners do that. You cram a lot of good information in there, Joseph. And I want to dive in a little bit more. We've talked a little bit about this in the past on what the Trump administration policies around deregulation could mean for the oil patch, what it means for global trade. You brought up tariffs there, but also the idea, the infamous drill, baby, drill. There's a big push that he wants to open up more drilling and even sign some executive orders the first day in office, the Trump administration. But oil companies themselves maybe don't see the incentive to drill, baby, drill unless there's higher prices. So maybe talk about the disconnect between policymakers and the oil companies.
Yeah, first thing, the Baker Hughes weekly data that comes out on Fridays, which we cover, as I said, in Ion Energy, is showing that the total rig count for the U.S. is down 6.5% from a year ago, 620 rigs working this year, 580. And of that, 98 of those are working for natural gas, down from 120, and 478 are drilling for oil, down for 497. And so the industry is using the discipline of rates of return, tier one inventories being drilled to replace declines. Wells are longer reach, they're going farther and farther. The completion techniques are getting better and better. So we're not seeing much down that 13.5, 13.6 million barrels a day of crude oil. And then remember, there's over 9 million barrels of natural gas liquids on top of that. So the U.S. is still, 22 million barrels or so production, and demand is 20. So they are fully self-sufficient now. And what what Trump is going to do is federal lands that Biden had said were not going to be allowed to be drilled in New Mexico, which is the extension of the Permian, and then offshore Gulf of America now. There's lots of federal lands there. And as you may have seen from the interview with the press that Trump had in the Oval Office, he said Anwar in one of the forms that he signed, executive orders, he opened up Alaska and Anwar. And so there's a lot of tier one inventory. Alaska is going to take longer because you need the right kind of ships, the drilling equipment, and winter, you need to have the ground the right way, and the timing of getting everything organized takes longer. Gulf of Mexico or Gulf of America now will just take as long as it's offshore, but getting the access to the lands and the company signing up to get those leases just opens the door. And then, maybe late this year, next year, we start seeing some action on the drill side. In terms of New Mexico and other federal lands onshore, that's something that can happen in the next few months. And we could see some activity fairly quickly, especially because companies have done a lot of the seismic already. So they know which are the lands that are the most attractive. And so once they get them, and if they get sufficient, acreage, where they can do the longer reach horizontals, then we should see some activity on tier one lands in New Mexico and other federal lands and other jurisdictions, which would probably mean an uptick. I don't believe, the 13.5, 13.6 is going to be exceeded until Q4, maybe down up to 13.7, 13.8. But in 2026, I think there's a possibility of 500,000 to 1 million barrels of new production. And then each year thereafter, maybe 1 million. And that 3 million barrels before the end of the decade, I think is not out of the picture in terms of incremental production. And that's on the crude oil side. Then you have to add in that, natural gas liquids come as well. So overall, you could see the United States go from 22 million to 26 to 27. And if it's still demand only 20 or 21, then they will have an export juggernaut. And that's why you hear Trump talking about telling Europe, hey, if you want to get rid of your budget, your trade deficit with us, buy our oil, buy our natural gas. And, likely the U.S. will have that production available. Just one thing on natural gas, European prices have gone up sharply recently because of the cold weather. And we've seen 6 cargoes that were heading towards Asia reverse and go to Europe because of the sharp decline in storage and very strong demand because of the cold weather.
I find this so interesting because, yes, companies aren't going to necessarily run out and just drill more because Trump wants them to. But this whole opening up of other land, federal land, that sounds like it's low-hanging fruit where companies can move in there. And even with these generally low rig counts, production in the U.S. is still quite stable at very high levels. So there's definitely this push and pull, but it does seem like that low-hanging fruit is these federal lands that Trump could open up and companies could move into right away. On the back of what else Trump could do, though, how could Canada be impacted by tariffs that Trump could put on Canadian natural gas or oil production?
Well, that's where I think Canada is going to have to, argue the point that there is a lot of benefit for the United States taking our heavy crude to their refineries in the Midwest and also in the Gulf of Mexico, Gulf of America. Again, have to get used to saying that more. And the key is we have a problem with immigration coming in from both East Coast and West Coast going into the States. And so we need to tighten up and not allow, migration to occur at the levels we have. We still are part of the fentanyl crisis, but other drugs are going in through the Canadian ports, be it Montreal or be it Vancouver, into the United States, causing problems for the Americans, and about 500,000 deaths of young people because of the fentanyl crisis. So we could do things that way. The other one that's interesting is if we finally get the Americans to agree, yeah, we want to have a continental energy policy, Canada and the States, and Mexico's not really a big part of it, because they're really not spending money drilling for oil onshore or offshore, but they could be part of it for, pipelines and LNG exports from Mexico in U.S. gas could go to those excess export markets. But if they want to have, us develop more of our oil sands and our SAGD projects, we're going to need another pipeline south. And so a lot of the inputs for pipe, compressor stations, all the steel inputs, technology inputs, that could be where we save, things for our trade deficit, where we say, look, we'll let American companies bid. And if their prices are within what the range is for Canadian companies, then they will have a good chance at getting, some of the business. So that plus maybe some give and take on the auto industry. And because, you look at the individual items that we have trade surplus, energy is a big component of it, but a lot of it is, and a lot of it's from Alberta and Saskatchewan, but there's also a lot from Quebec and Ontario because they sell electric power down to the northern U.S. states. So again, they don't want to black them out. So we're going to have to find other offsets. One of the ones you're hearing recently is about milk and eggs and other things that are being dumped. But I think in the eggs case, I think with the bird flu down in the States, they're going to want our eggs and our chicken. But on the case of, butter and milk, maybe the Canadian government is in the wrong with our production profiles for the industry. And maybe some of that will have to be part of the resolution. Even Australia complains about our dumping on them. Kind of impressive that Canada can be accused of dumping anything.
It's a wild situation with global trade, Joseph, but you brought up pipelines there, and I think that's an interesting topic. If we think back, the first day of the Biden administration, he killed the Keystone Pipeline with an executive order. Now, in this era of deregulation, do you think we'll see more pipelines? Because the U.S. still really needs Canadian heavy oil in the refineries to make diesel. The problem is diesel for trucking, but also how that could possibly tie into more pipelines for nat gas. Could you maybe speak to how infrastructure between Canada and the U.S. could create some opportunities for companies or even oil service companies?
Yeah, so if you listen to the announcements from Enbridge and TC Energy, they all can tweak and add, 5, 10% to their numbers with just adding compression, twinning some pipelines. But to really make a difference, it means new pipelines. And as you may have seen in the press today, one of the First Nations leaders in BC who was totally against the Northern Gateway pipeline said that we need to find more export capacity on the West Coast, and he reversed his opposition. So we're beginning to get more and more buy-in from the First Nations. The question is what's going to happen with the BC government in favor of it? What happens federally? Do we have the Liberals in charge, or is it Poilievre and the Conservatives who are pro-growth to the energy industry? So there's a lot of wild cards in 2025. Will Trump say, "Hey, I want the XL pipeline. We want to get that up and running again, and we want that process to move forward." Do we want to have? Of course, he's removed any opposition to LNG new facilities. He reversed the Biden move there. So there's going to be a lot of movement here over time as Trump's policies get moved down and he gets his cabinet approved. So I think we're in interesting times here. And of course, Canada being a big part of it because of the continental policy of our energy industries, because again, the U.S. sends oil and natural gas into Eastern Canada. We sell into the Midwest. It really is a continental policy, and tariffs of 25% on it for our oil and our electricity just doesn't make any sense, because all it does is drive up consumer prices in the States. And that's the reverse of what Trump's policies, his election promises.
Let's talk some of the energy stocks then, because look, along with the stronger oil price, stronger natural gas price, a lot of the ETFs that I follow that hold the energy stocks, those have also done very well. Some not quite back to some of those highs that we saw back in November, but again, it's been a very strong rebound. I know you were waiting to issue a lot of buy signals at the end of tax loss selling, and I think you're even waiting for a slightly lower oil price. Where do we stand now, Joseph, and what's available and where the opportunities are for natural gas and oil stocks?
Okay, first, we said that we expected a very attractive buy window during tax loss selling season. That did occur. We told our people to take advantage of it. We did ourselves. My wife and I added to our positions and nearly got us to nearly fully weighted. But I thought we would see a bounce thereafter, which happened, and many stocks bounced 20% or more from the lows of tax loss selling season. And now I think we're going to see a pullback if we get oil down below 70 in the next few months because of fundamental reasons. And then I think that gives us another buy signal, maybe not as good as what we got during tax loss selling or during September when we had those, when we sent out a lot of buy recommendations in September of 2024. But again, I think the next window for people to be putting any capital they want to put to the energy sector, I think that'll happen during Q1. We'll have, we're going to be talking to you guys on a regular basis. So anytime we get under $70, people should be looking at the bargains out there and deciding which ones they want to have to add to current positions or to start new positions. Under $70, I think we're going to see some great opportunities, and we'll be highlighting those to our clients and in general terms in our commentary on energy.
Well, Joseph, if we look at the nat gas stocks, the gassers have really been performing, but maybe not as much as people expected, considering that nat gas prices on the futures are up near $4. But it's also a regional thing. There's parts of the U.S. and parts of Canada that have fluctuating nat gas prices based on their region. Any opportunities that you're seeing in the nat gas stocks?
Well, they did get down quite a bit cheaper during tax loss selling in late November, December. They've bounced quite a bit since then. I think could potentially 5-10% back offs here in the coming couple of weeks. So I would, find names that you like, do your homework on the names, and then be ready to take advantage if we do see sub $70 in the next few weeks. And I think that's going to be the approach I'm taking. And what I would think people are, if they took advantage of the September opportunity and then tax loss selling, they should be in the 80-90% weighting of what they want towards the energy sector. The next pullback should get them where they want to take whatever their position is, depending upon if they want to be market weight, if they want to be overweight or underweight. That's when we would think that they should allocate back into the sector. And again, the bargains are there in the oil side. The bargains are there, were there in December and in September, both in oil, natural gas, and the service sector. And we expect, and even for some royalty income funds like a freehold. So there's opportunities here that people can take advantage of, when we see some weakness. And again, we're talking maybe 5% for some of the bigger cap names, maybe 10% for smaller companies. But if you can be nimble and take advantage of that over the next few weeks on a pullback below U.S. $70 WTI, I think that would be my recommendation for those who are watching the markets and are more nimble.
Any dividend-paying stocks or high dividend stocks that you have your eye on that you think not only offer that kind of cash flow, but also are solid companies that could offer some capital gains growth?
Sure. As I mentioned on the Royalty Trust Freehold, which is yielding you an 8% dividend yield. On the natural gas side, Birchcliff is yielding 6.8%. Paramount Resources, 5.7%. You've got Whitecap at 7%. Varen, just around 6%. You've got Pinecliff, 6.4%. Surge Energy, 8.5%. Alvo Petro, 9.5%. In Play Oil, 10%. So there's some very, very nice yields out there. And again, if we do get a 5% correction, then those yields even get better. So, being nimble and being able to, make that decision. And I think the thing is, when should I be starting to watch for the bargains? My comment is watch for a breach of $70 WTI, and then I'd be looking to see which names fit your portfolio profile and risk tolerance, and then make your moves thereafter.
Well, Joseph, I want to circle back one more time to the gassers and compare U.S. versus Canadian. Where I was getting at on the last question is when I look at some of the U.S. producers like Antero or EQT, they've had huge runs for the last year or two and really participated in that gas price. But you brought up Birchcliff and Pinecliff there, both companies that have good exposure to the nat gas sector, and they haven't really ripped as high. So is there a arbitrage to play the Canadian companies that have more exposure to nat gas over the U.S. companies?
Yeah, I think you're looking at, $3.94 today for NYMEX US, and you're only getting $1.90 Canadian for AECO. So companies that are locked in with a lot of their production in the lower price Canadian market are not going to be, not going to have the cash flows that their American peers would have. But going into the middle part of this year, we're going to have LNG Canada come on, and I think we're going to be looking at, $2.50, $3 kind of range for the Canadian prices during the summer and spring and fall. And then when you get into the winter of 2025-26, I think we could be looking at $3-4 numbers Canadian. And so that gives you a very attractive price for that. So we've been adding ourselves to the natural gas names because we, with dividend yields, because we just believe that if we get to that $3-4 handle, these stocks potentially could be doubles over the next 12 to 18 months.
All right, Joseph. Great having you on the show. Thanks for joining us on the KE Report Weekend Show. Again, Josef Schachter, founder and editor of the Schachter Energy Report, as well as writes the Ion Energy Report. You can find a link in the show notes to Joseph's website. And everyone, again, thanks for tuning in to this weekend show. Be sure to go back through our website, kereport.com, and podcast. Just search the KE Report in your podcast player to listen to all our daily editorials and company updates we release throughout the week. Joseph, again, thanks for taking time on this weekend show. And everyone, thanks for spending some of your weekend with us. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.